Morning everybody and welcome to the Aquila Markets macro update this morning on the 16th of April, and always before viewing any of our content please view all our terms and conditions at aquilamarkets.com. So let's really get started. It's been a fascinating week this week for markets. Two main things that I think have really stuck out for us from the fundamental point of view. One is the strength of the US data. The CPI was very strong earlier in the week. And obviously retail sales yesterday was a huge blowout. What was really interesting about the US retail sales yesterday was that actually when you looked at the numbers, online sales have not really dropped at all, while in-person sales have really picked up in the month of March. That kind of tells you the pent-up demand of the consumer in the US. So that I think is really interesting. The second thing that's been really interesting has been the strength in the US bond auctions. And that's really what we're going to be focusing on today, and what we really want to talk about today has been some of these moves in US rates that are really driving a lot of this market, and we're seeing it at the moment because the market is staying in what we think is this Goldilocks phase for now. Lower yields and higher equities are reflexive. They both feed into this concept of financial conditions, and that and a slightly weaker dollar means that we just get this turbocharging effect. And the final thing, of course, that's really happened has been this move lower in the VIX. See the VIX here, well below 20, which has been our pivot. We haven't really gotten below 20 for over a year, and then we broke down it about 2 weeks ago. And we can see we're in this 15 to 20 zone. Just look at the percentile for the VIX. It's in its third percentile over the last year. It's basically on the lows. And of course, when we have lower volatility, we have higher position sizes to get the same risk-adjusted return. So when vol is low, position sizes go up. So this is feeding through into this market that is chasing winners, constantly chasing winners. What's really interesting to us is how quick the market has been to say that the high in bond yields, we've seen those, and we're going to basically, the world is going to be going to a situation where US growth has peaked, US inflation has peaked, and what we think is happening, and we talk about this all the time, is about the market fitting narratives to price action. So it sees a short-term market move and it thinks it has to create a fundamental reason why that happens. That is not how markets work. Markets work because of flows and because of the underlying trading that goes on in them that makes prices go up or down. So we're really very wary, and we've made this point repeatedly, that this is a key theme of ours, is this narrative fitting. Because at the end of the day, what has the Fed told us this week as well? The Fed has told us, again, Powell and particularly Vice Chair Clarida, have said that the Fed is totally focused on inflation data. They aren't going to look at any other data. They're not going to look at housing data or retail sales or trade data or anything else. They're going to look at the inflation data. Core PCE is what the Fed looks at for inflation. He wants to get it above 2%. He wants to stay above 2% for a while, and then they're going to think about tapering and various other things. So they are totally and 100% focused on getting inflation up. And the second thing, of course, is that we have this unparalleled fiscal stimulus in the States. Just extraordinary scale and scope in terms of the amount of money that's being printed. And we've got this situation where global tensions around the world just remain very, very high. So when we look at the dashboard today, clearly the things that jump out to us just on this last week has been huge performance on of the reflation plays thrown through oil and copper, break up in copper, finally broke out of the triangle we've been talking about. Bitcoin obviously blasting its way to the upside too. And we've seen some dollar weakness, and naturally we've seen yields go down. And we've seen this relative performance therefore in equities up and the VIX lower too. When we come and look at the sector situation, it's kind of a mess. If we look at what's happened on the last week, growth has outperformed value. That makes sense. Tech has really led this move. The Russell has underperformed the small cap. That's kind of interesting. Lower rates should be good for the Russell, but that's not really feeding through at all. Where it's really driving, as we can see, is really in Nasdaq. But if we look at the winners, let's just look at the winners over the last week. You'd expect tech to really be leading, but actually we've got healthcare, we've got materials, got gold miners and utilities. They're kind of, safe haven type of equities. They don't necessarily should be performing in the same way that they are when rates are moving down. And semiconductors are, lower, are sort of on the low side. Oil and gas is on the low side. In other words, it's very idiosyncratic. It's quite hard to pick through what the themes are from the sectors right now. And that's interesting because that tells us something too. That tells us additionally that this market is being driven by short-term flow driving into specific markets. So let's come and look at what changes we've made on the dashboard. We have closed out the cable call spreads. Cable's just not performing for us. It just isn't giving us any love to the upside. So let's just get rid of those. We have added some Nasdaq calls put spreads. The 135, 125 put spreads, you can see those here. We're going to talk about that trade in a second. And we've rolled out our VIX call spreads, and we're going to talk about those in a second. Just look here at the dashboard, and I've deliberately not changed these numbers so you can just see what's happened here. TLT, that's a measure of bonds, of bond prices. Higher TLT means basically higher bonds above the upside pivot, so breaking higher. Let's look at oil. Oil has broken above the up pivot. Copper has broken above the up pivot. The dollar index is below the down pivot. You get the idea. What we're having here is we're seeing waves and waves of this Goldilocks play suddenly starting to play out. But we're questioning whether it's really sustainable. So let's come and look at global rates. So this is a chart we pull up a lot. This is basically, US 30-year, 10-year, 5-year, and the 2-year. And then we've got the German Bund rate, and we've got UK rates. And it shows just really clearly where everybody's rates are within sort of relative to everything else. But we can see that actually on the 18th of March was when US 30 years peaked in rate terms, and interest rates have been going down since then. We can see in the 10-year we made a kind of a double top here around 170, and then we broke lower to where we are right now. And there has been this moderation in the rate move. Now people will start to fit narratives to that and say there's a fundamental reason for this. There are actually 3 reasons we believe why bond prices have gone up and yields have gone down in the past 2 weeks. The first has been very, very large demand from real money holders. There are still people who need to buy bonds with fixed coupons to fund liabilities. Pension funds, and particularly in Japan, the life companies over there, so insurance companies. These are the guys that need to buy bonds to create cash flows with money that they hold. There's been large buyers in that. Secondly, we know there has been a massive short in bonds from the CTAs and short-term speculators. That we know. We've seen that from the big spike up that we saw back here all the way through February and into March. And those guys are just getting squeezed. That's one of the features of this market that we've been bringing up, is this constant short squeezing of positions. Market hunts out the pain, and it just keeps doing it again and again and again. Bonds are securities. And I keep making this point, and for some of our new members, I just really want to say it again. Interest rates are derived from bond prices. That's where they come from. And at the end of the day, bonds are securities. They have bids and offers, they go up and down, they have positions, they have liquidity, they have all the other things that go on around how markets work. And so it's the move in the bonds that are being driven by these relative idiosyncratic factors of positioning, demand, and finally I think there's probably this latent geopolitical demand. We've still got these issues in Ukraine, we've got the issues in Turkey, in Taiwan, we've got issues in Turkey as well. But point being, this is a market that can get squeezed. It's just a squeeze. That's what's happened. And so therefore we come and look at the 30-year, and we just remember that these auctions have been very, very strong. They have. The 30-year auction that we had this week, bonds were sold at 2.32%. That was the same day as CPI came out at 2.6. So in other words, people were buying bonds with a negative real yield, that's the yield I get on my bond in nominal terms, less inflation, of negative 2.8%. 0.28%, I apologise. This is unprecedented, right? It virtually never happened before. I think it happened once in the late 80s. But point is, this is extremely rare. And so we've been waiting for this move, right? We know how many bonds have got to be issued. And it's one of the core reasons why we think that rates are going to continue to go higher. So our initial target level was 220 to 223, the 38.2% retracement. And it actually was the 50-day moving average, which has obviously ticked up a wee bit. We tested it yesterday and then bounced pretty hard when Laurie Logan, the Fed's head of the New York Fed's markets board, came out and said basically that we're potentially going to be selling less 30, we're going to be buying less 30-year because we're going to be buying more 20-year. And that just caused this huge pop into the close. So we're really focused on this now because there are lots of ways to play what we think could be the resumption in the move up in rates. We don't buy this fundamental narrative change at all. We could be short bonds, right? That's one way. We could be short TLT is the way to do that. Or we could be long dollar yen, and we still are long dollar yen. And we're kind of hoping that dollar yen goes down to this low 108s for us to be able to add, but we're still long those trades. The other way, of course, is to look at the Nasdaq, because the relationship between the Nasdaq and US rates has been very strong. Over the long term, we've made this argument for many, many years that the suppression of rates has basically allowed businesses to flourish that have a zero cost of capital, right? They don't need to make money. Money's free. They can borrow as much as they want and get investors to give them cash to be able to build these businesses. And of course, for every one of these high-tech businesses these fintech businesses that perform to the upside and succeed. There are thousands that don't, that nobody ever seems to talk about. But the simple fact is that when we look at this in the short term, what was really fascinating to us is that when we saw, this is the yellow line, the orange line here, which is 10-year yields, when we broke up fast above 1.2%, the Nasdaq came straight down here in blue. We saw it go down. As the momentum started to wane, the Nasdaq just found an equilibrium point and just went into the chop. We talked about this a couple of weeks ago, and then we got the breakout to the upside. Look when the breakout to the upside happened. Month end, 30th of March, at a time when rates tick lower. So rates tick lower, and that fueled this big rally in the Nasdaq, obviously to the upside. And this market continues to chase those winners. So we are really thinking about whether the trade here is to think about Nasdaq on the downside, right? And how do we play that? That could be a really neat way of playing the overvalued Nasdaq side. Great portfolio hedge. But the other thing that's really interesting to us has been volatility. So vol has been kept very low. And that's been one of the features of the Goldilocks scenario. Lower vol, bigger positions, like I said earlier. So the VIX, people call it the fear gauge, the VIX is actually a measure of the implied volatility of S&P 500 options. But because we can buy options on the VIX itself, it has a volatility index all of its own. It's called the VVIX. And you can see here that the VVIX is in blue and the VIX is in red. But one thing I really want to point out is what happens here when we get a situation when the VVIX suddenly turns up but the VIX lags. We can notice this has happened over these past week or so, that the demand for VIX options is going up even at a time when the VIX is breaking lower. This is particularly interesting for us because this is a very, very important early signal of volatility being oversold. And that doesn't mean that just that vol goes up, but the volatility in markets is going to pick up as well. And therefore we come back to our Nasdaq trade here and we look at this. This is a weekly chart. It never fails to amaze us, just the scale of this move to the upside. This 14,000 level in the Nasdaq, along with 4,000 in the S&P, was something that I said on a conference call about a year ago. People thought I was nuts. I thought I was nuts, quite frankly. But here we are, extraordinary moves. But the thing I want to point out here, let's just look at this is on a weekly chart. Lower RSIs, new highs. That's a classic RSI divergence. I know it's over a big picture period, but it still matters. We've talked about the weakness of the internals in the US equity market, and we wonder whether we suddenly get a pickup in rates here and we see the Nasdaq start to move to the downside. And the way to play that, to take advantage of volatility being really low, and the fact that we're going to think that we're going to get a move. If the Nasdaq goes low and higher rates, vol is going to go up as well, is we want to own optionality. And we've done that through the put spreads that we've put on. We've put those on the radar screen here that you can see. These 135, 125 put spreads. And you can see they've got 1,000 payoff, basically 1,000 points of payoff for 160. It's a 6.25 to 1 bet. That's exactly the kind of trade we love to do here at Aquila because we think that is really, really great risk reward. Longer one for us. That's it from us today. Have a great weekend, everybody. And let's see what these great markets give us. All the best.